82% discount. Book value, $2.7 billion. Hammer price, $500 million. For some, collapse. For others, clearance. The buyer was neither a Korean firm nor a Korean bank, a Texas private equity fund. To understand how this price became possible, we travel not to Seoul in 1999, but to Bangkok in 1997. Early to mid-1990s, the World Bank called Asia a miracle. Korea, Thailand, Indonesia, Malaysia, growing 7 to 9% annually. Exports rising, factories humming, foreign capital flooding in. 2/3 of all capital flowing to emerging markets globally concentrated in East Asia. The world believed in Asia. But beneath the miracle lay invisible traps. Asian nations pegged their currencies to the dollar. Thai baht fixed at 25 to $1. Korean won, Indonesian rupiah, same structure. On the surface, stable. No currency volatility meant foreign capital flowed more easily, but that very stability was the trap. Peg the currency to the dollar, a nation loses monetary autonomy. Interest rates stop being theirs to control. They wanted capital mobility. They wanted fixed exchange rates. They wanted independent interest rates. Economics says, pick two, never three. This impossible trinity is inviolable. Asian nations tried to keep all three at once. Dollar strength returned after 1995. Cracks appeared. Strong dollar meant currencies pegged to it gained real value. Export prices climbed. Korean semiconductors, Thai textiles, Indonesian commodities, all expensive on world markets. Thai export growth collapsed. 24.8% in 1995 to 1.9% in 1996. Current account deficits accumulated. Thailand, 8% of GDP. Korea, 4.4% of GDP. Yet they maintained the peg. Abandoning dollar peg meant foreign capital would flee. They knew the problem. They couldn't change the structure. Desperation shapes price. Another time bomb. Short-term debt. Thai financial institutions borrowed short-term dollars overseas, then lent them long-term to domestic real estate and infrastructure projects. Borrow short, lend long. When maturity arrives, refinance or default. One creditor's refusal breaks the chain. Numbers revealed the danger. June 1997. Thailand owed $45.5 billion within 1 year. Usable forex reserves, only $2.9 billion. Debt was 15 times ammunition. Official reserves of $31.3 billion were already locked in forward contracts. Empty gun. The world thought otherwise. George Soros's quantum fund detected the scent. Thai baht overvalued against the dollar. Thai central bank had no ammunition to defend. If these premises held, shorting baht was nearly one-directional. Profit came from collapse. Loss required the bank to win, but winning was impossible from the start. From early 1997, hedge funds, including Quantum, began massive baht sales via forward contracts at 26 baht per dollar. Total estimated net short position, $7 billion. Thailand's central bank fought back, burning foreign reserves to defend the baht. Requested Singapore support. On May 14, 1997 alone, $10 billion in forex spent. One day. Bullets gone. July 2, 1997. Thailand's central bank surrendered. Dollar peg abandoned. Floating rate adopted. Baht plummeted from 24.52 to 30.18 per dollar on a single day. 17% vaporized instantly. Later fell to 56 per dollar. Soros's Quantum earned approximately $2 billion. What the central bank lost, Soros pocketed. Defending the dam cost tax revenue from ordinary Thais. Thailand's dam broke. Fire spread across borders. Yet at each frontier, crisis wore a different face. Indonesian rupiah trembled. Malaysian ringgit. Philippine peso. Foreign creditors withdrew from all Southeast Asia at once, refused to roll over short-term loans. Between 1996 and 1998, $118 billion fled 5 East Asian nations. Indonesian rupiah fell from 2,400 to 15,000 per dollar. 80% currency vaporized. Firms borrowing dollars faced debt multiplication overnight, 6 times larger in rupiah terms. May 1998 saw massive riots. Suharto's 32-year regime collapsed. Currency collapse became political collapse. Then, crisis moved northeast. What began in Thailand as currency collapse arrived in Korea as credit collapse. Korea had just celebrated OECD entry, developed nation status. Per capita GDP, $10,800. Unemployment, under 2%. Appearance, intact. Reality, finance companies borrowed short-term dollars abroad, invested in high-yield bonds across Thailand and Indonesia. Year start catastrophe, Hanbo Steel, Kia Motors. Conglomerates cascaded into default. Bad loans surfaced. Foreign banks halted refinancing of Korean finance company short-term debt. November 21, 1997. Korea's government formally requested IMF bailout, 1 year after OECD membership. December 23, 1997. 1,961 per dollar. Months earlier, 900 won. Rate doubled. Won value erased 50%. Kospi index, from 1,000 to 280. For those holding dollars, the entire nation became half price. City streets transformed. January 1998. Koreans lined bank branches. Rings, necklaces, wedding bands, gold medals. Athletes surrendered Olympic golds. War veterans brought military honors. A cardinal donated a lifelong cross. 2 months, 3.5 million participants, 226 tons, $2.2 billion. Not government bonds, not rescue funds. Money extracted from lives themselves. Foreign investors saw not statistics, but citizens surrendering assets to state. Credit returned, but behind credibility's open door, a different transaction unfolded. IMF rescue came with conditions. Money always carries a price. December 12, 2330, 1997. In those days, foreign investor stock limits rose from 26% to 50% to unlimited. Corporate bond markets opened entirely. Hostile M&A permitted. Every gate unlocked. Simultaneously, call rates soared from 12.5% to over 30%. But Korean firms carried 400% debt-to-equity ratios on average. 30% interest rates spelled execution for them. Profitable companies collapsed under interest alone. Nation, 50% currency collapse. Nation, 30% plus interest rates. Nation, assets at bottom. Nation, foreign investment limits removed. For dollar holders, this constellation of conditions created a structural discount window never before seen. Newbridge Capital, later known as TPG Capital, private equity firm from Texas and San Francisco. Target, Shield Bank. First foreign PE acquisition of an Asian bank in history. No precedent existed. Chail Bank, 100 years old, major Korean bank. But reckless lending to Hanbo Steel, Daewoo Group. Sponsors collapsed, leaving mountains of bad debt. Capital entirely eroded. Government already poured astronomical amounts to keep it alive. Yet no self-rescue path remained. Seller desperate, buyer patient. This asymmetry set the price. Negotiation, 18 months. December 1999, result. Newbridge Capital paid $500 million, acquiring 51% ownership and control of Chail Bank. Book value, $2.7 billion. Discount, 82%. Surface reading, Crisis-era bargain. But true price didn't appear on deal line. It was elsewhere, in contract text. Putback option. Within 2 years of acquisition, any newly discovered non-performing loans get repurchased by Korea's government at full par value. Translation: Newbridge owned the bank, but future losses stayed government liability. Upside: Newbridge. Downside: taxpayer. During Newbridge's operational period, Korea injected an additional 6.25 trillion won of public funds. Wealth hasn't disappeared. It transferred. Newbridge reduced crony lending, shifted to retail. Introduced performance metrics, risk committees. Bank's DNA changed. 2005. Newbridge placed Chile on market. British Standard Chartered bought it for $3.3 billion. 500 million invested became 3.3 billion, 6.6 times original. One thing more. Newbridge incorporated in tax haven Labuan, Malaysia. Under Korea-Malaysia Tax Treaty, capital gains of 1.2 trillion won owed 0 Korean taxes. Loss socialized, gain privatized. Structure determined outcome. Lone Star funds entered Korea from a different angle. Not banks. Bad debt. Texas-based, Dallas-headquartered, specialty. Hunting distressed assets in global crisis zones. December 1998. Lone Star purchased a package of collateralized non-performing loans. Nominal: 565 billion won. Price: 201 billion won. 36% of par. Financing structure proved more audacious. 70% of purchase price financed through offshore special purpose entities. Actual capital deployed: 60 billion won. 2001. Lone Star bought Gangnam Star Tower for 663 billion won. 2003. Acquired 51% of Korea Exchange Bank for 1.38 trillion won. Lone Star's story became a decade of litigation. KEB sale witnessed executive conviction for stock manipulation. This winner's narrative never achieved clarity. Smart money doesn't always win. Soros took identical losses in Russia a year later. When structure aligns, genius emerges. When structure misaligns, identical strategy collapses. Which side a government chooses? No algorithm predicts it. Pure opacity. Post-1997. Asian nations rewrote strategy. Prevent recurrence. Accumulate forex. China, $3 trillion. Korea, over $400 billion. 2000. 13 Asian nations launched Chiang Mai Initiative. Multilateral currency swap for crisis moments. No more defending empty dams. Ammunition rebuilt. Dams rebuilt. Forex stacked. Asia grew again. But ownership of flooded assets never returned. Kale Bank moved from American PE to British Bank. Lone Star bought Gangnam buildings, sold them later. Collapsed discount coupons. Only dollar holders could use them. Wealth doesn't disappear. It migrates. Ask yourself now, what percentage of your assets are denominated in a currency that could collapse overnight? If your local currency lost half its value tomorrow, how much of your net worth would survive? Priced in dollars, in gold, in anything that holds when the dam breaks. The people of 1997 believed in perpetual miracles until the dam broke. When crisis passes, people watch exchange rates. But what endures longer are the changes in ownership registries. Next crisis. Will you be on the side that loses, or the side that issues the discount?